Definition of insurance. Insurance, pooling of fortuitous losses by transfer of such risks to insurers. Insurer agree to indemnify insureds for such losses, to provide other pecuniary benefits on their occurrence. Basic characteristics of insurance. Pooling of losses. Spreading losses incurred by the few over the entire group. Risk reduction is based on the law of large numbers. Law of large numbers: the greater the number of exposures, the more closely will the actual results approach the probable results that are expected from an infinite number of exposures. Example of pooling. Two business owners own identical buildings valued at $50,000. There is a 10% chance each building will be destroyed by a peril in any year. Loss to either building is an independent event. Expected value and standard deviation of the loss for each owner is. Example, continued. If the owners instead combine their loss exposures, and each agrees to pay an equal share of any loss that might occur, the standard deviation continues to decline while the expected value of the loss remains unchanged, as additional individuals are added to the pool. Payment of fortuitous losses. A fortuitous loss is one that is unforeseen, unexpected, and occur as a result of chance. Risk transfer. A pure risk is transferred from the insured to the insurer, who typically is in a stronger financial position. Indemnification. The insured is restored to his or her approximate financial position prior to the occurrence of the loss. Basic characteristics of insurance. Adverse selection and insurance. Adverse selection, tendency of persons with a higher than average chance of loss to seek insurance at standard rates. If not controlled by underwriting, adverse selection results in higher than expected loss levels. Adverse selection can be controlled by careful underwriting, selection and classification of applicants for insurance. Policy provisions. For example, suicide clause in life insurance. Insurance. Insurance is a technique for handling an already existing pure risk. Insurance is always socially productive. Both parties have a common interest in the prevention of a loss. Gambling. Gambling creates a new speculative risk. Gambling is not socially productive. The winner's gain comes at the expense of the loser.